Hello, this video is part 2 of chapter 1. In this video, we will continue discussing the key terms from the topic 1, which is an overview of financial management and the financial environment. Financial markets bring together people and organizations wanting to borrow money with those having surplus funds. On average, individual households are net lenders. Non-financial corporations are net borrowers. Federal, state, and local governments are net borrowers, and financial intermediaries borrow slightly more than they lend. Transfer of capital between savers and borrowers take place in three different ways: direct transfers, transfer through an investment banking house, and transfers through the financial intermediaries. Direct transfers of money and securities occur when a business sells its stocks or bonds directly to the savers without going through any type of financial institution. Transfers through the investment banking house occur when a brokerage firm such as Merrill Lynch serves as a middleman and facilitates the issuance of securities. These middlemen help corporations design securities that will be attractive to the investors, buy the securities from the corporations, and then resell them to savers in the primary markets. Transfer through the financial intermediary occurs when a bank or a mutual fund obtains funds from the savers, issues its own securities in exchange, and then uses these funds to purchase other securities. Financial securities. Transfer of capital often leads to a creation of new financial securities. We can classify most of the financial securities along two dimensions: time until maturity, debt, equity, and derivatives. Securities that mature in less than 1 year are called money market securities. Those that mature in more than 1 year are called capital market securities. Debt instruments typically have specified payments and a specified maturity. Equity instruments are a claim upon residual value. Derivatives are securities whose values depend on or are derived from the values of some other traded assets. Now let's discuss how the firms issue securities. Two types of primary issues of stock. One is IPO, initial public offering. These are the stocks that are issued by formerly closed held companies that are going public. Second is the seasoned issued. These are the new stocks offered by the companies that already have floated equity. In case of bonds, a public offering refers to the bond issue which is offered to the investing public, while a private placement refers to an issue sold to a few institutional investors and usually held until maturity. Investment bankers undertake the marketing of public offering of stock and bonds and are known in that capacity as underwriters. They help the corporation design the securities with features that are currently attractive to the investors, buy these securities from the corporations, and resell them to the savers. The investment banker essentially acts as a broker to help transfer capital from savers to the business. A preliminary registration statement or prospectus, which describes the issue and the prospectus of the company, is filed with Securities and Exchange Commission. The SEC regulates the operations of financial markets in the United States. Once the prospectus is approved by the SEC, the price of the security is announced. Now let's discuss the stock market. Stock market is the secondary market and it is useful for quick liquidity when the investors desire money in a timely manner. By far the most important type of secondary to market to financial managers is the stock market, where the prices of the firm stocks are established. Three basic types of stock markets are organized exchanges, over the counter, and electronic communication networks. Organized exchanges, example NYSE and AMEX, trade listed stocks that must meet listing requirements. The traditional version of the tangible entity with its own buildings and the board of governors, while the electronic version of an organized exchange, which is NASDAQ, is made up of vast network of broker-dealers who are linked together by the telephone, computer systems, etc., through which they deal directly with each other and with the customers. Over-the-counter markets, OTC. Any market for trading securities other than on an organized stock exchange is considered as over-the-counter market. It usually trades stocks of the firms that do not meet the listing requirements. Electronic communication network is a fully automated trading system with no human brokerage or dealership intervention. Let's discuss the trading on exchanging. Participants. An investor interested in buying or selling securities contacts a broker at a brokerage firm. This firm owns a seat on the exchange. This seat is occupied by its commission broker, who executes the investor's orders. If the commission broker is too busy to execute the order, he/she passes it on to the floor broker. The floor broker is a freelance trader on the exchange. Registered traders avoid going through the broker by executing trades of their own accounts. Types of orders. There are different kinds of orders that can be placed in the secondary market. Market orders. Market orders are buy or sell orders that are to be executed immediately at the market price. Limit order specifies the prices at which the investor is willing to buy or sell a security. A limit buy order instructs the broker to buy the stock if and when a share falls below a certain value. A limit sell order instructs a broker to sell the security if its price rises above a specified limit. Day order lasts for a day. If the order is not executed by the close of the trading that day, it is cancelled. A stop loss order instructs the broker to sell the security if its price falls below a certain level. A good till cancelled order or open order is self-explanatory. The order remains effective until cancelled by the investor. A specialist, also called a designated market maker, is a central figure in the execution of the trades. He or she is required to make the market for the shares of one or more firms as assigned by the New York State Stock Exchange. The specialist acts as a broker and the dealer. As a broker, he executes the orders for other brokers. As a dealer, he deals in buying and selling stocks off their own accounts and keeping the inventory for several stocks. Specialist maintains a fair market by continually adjusting security prices in order to equalize the supply and demand.